Us now is Michelle Meyer, Bank of America's head of U.S. economics. Mike Santoli with us as well. Michelle, it must be hard as an economist right now to make projections and forecasts on numbers. You guys are doing it. What are you looking at right now that tells us we're in recession and it's going to get deeper?
Sure. So we're looking at high frequency data. We're looking at what we're seeing in markets. Financial conditions are extremely important in terms of being able to determine what we think we might see in the outlook. So we're relying on high frequency indicators, survey data, sentiment shifts, and also trying to take into account potential moves in policy as well.
And Michelle, what numbers have you come out with?
So unfortunately, we do think it's a recession, and we think we're already in the recession. So what we're really focused on is trying to understand Q2 GDP, and we think it's going to be quite a large decline. We're looking for a 12% drop on a quarter-over-quarter annualized basis in Q2. That would be the biggest in post-war history. So it sounds severe, and it is severe. But the good news is that we think it will end up being somewhat short-lived, and we do look for positive growth to start in the third quarter. So for the full year, we think we'll see minus 0.8%. So it will be painful, certainly the next few months. But if we have aggressive and targeted policy, we think we'll be able to pull out of this.
Mike Santoli, 12%. Decline in economic growth in the second quarter. I think JP Morgan's at down 14% in the second quarter. Are these kind of numbers and this kind of economic destruction factored into the market?
It's hard to map the market response so far to a particular GDP forecast. Obviously, we're down 30% in the S&P 500 in 1 month. If you go back through history, 30% is roughly where a lot of recessionary bear markets got you to. The problem is, I think the duration of this and the manner in which we come out of it, and even the manner in which we're going into it, are relatively unprecedented. So I think it's tough to map that specifically. I think duration and how much attrition in terms of business wear and tear, business failures, defaults, things like that are knock-on effects of this very sharp sudden stop in the economy or what the market is trying to sort out right now. But I do think if it's a one-quarter event, the depth of it might not be that important as opposed to the collateral damage and how fast it comes back.
Michelle, clearly there's a huge amount of stimulus from central banks and governments all over the world, including here in the U.S., being announced every day now, it seems. Can that halt the size of decline in Q2, or if it bleeds into Q3 at all? Or is the government and central bank stimulus only something that has a chance to affect the shape of the rebound from being a V or a U or an L?
It's a very important question, and I tend to think that it's more of the latter. In the sense that the reason the economy is falling as rapidly as we think it is because of the containment efforts that are being put into place. So state and local governments are going out and effectively shutting down large cities, shutting down the economies, particularly the service economy, with hopes that it will prevent a bigger crisis and it will prevent the spread. And so it's short-term pain for hopefully long-term benefits. Now, during that period of time, if you see targeted fiscal policy that offsets some of that income shock, once we get past the spread of the virus, which hopefully is in short order, then the economy can resume to a more normal function because you've had this offset from fiscal policy. And also importantly, when it comes to the central bank, the Federal Reserve, they're acting in an extremely important way right now, trying to maintain market stability, make sure that there's liquidity in the market, that there's a flow of credit. And if they're successful there as well, then you can see how the recovery could occur. But to me, when I look at fiscal policy, when I look at monetary policy, it's the efforts, I think, are designed to try to get us out of this big shock.
Michelle, I don't understand how any economist or strategist or investor can make a projection about a third quarter. I mean, are you guys at Bank of America talking to epidemiologists? How are you figuring out when economic growth can return if we're not getting any guidance on when restaurants and stores can open and when we can get back to our business as usual?
Yeah, no, you're absolutely right, Sarah. I mean, there's a big error band, which I think we all have to be really honest about when we're making these forecasts. Now, what we can do is try to estimate the drag in a fairly precise way by breaking the economy down and doing a bottoms-up estimate, thinking about how travel-related spending might decline, but necessary spending might actually do a little bit better. So you can get some sense of the magnitude of the downturn. But you're right, it's that upturn that I think is really hard to reconcile. And we're doing our best in terms of trying to understand what's happened elsewhere. So look at what's happened in China, for example, and how they were able to resume higher growth. Factories were able to open. Now, in China, it's more of a goods economy, so it's probably a little bit of a sharper move than here in the U.S., where it's more services-based. The other thing, of course, we can't account for is psychology, right? How are animal spirits changing? How are people's perceptions about work and living changing? We can't control for that. We have to just do our best.
Well, we will check in with you when we know more. Michelle Meyer, thank you for joining us.
Absolutely.